Good morning, Bitcoiners. Hello, and welcome back to a very special Labor Day Monday edition of your economic calendar. I'm Mauricio, co-founder of Ledn, and as with every Monday, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is Monday, September 6th, Labor Day Monday in Canada and the US, as we mentioned, so very happy Labor Day to our friends in the US and Canada celebrating today. In today's episode, we're going to start by talking about Bitcoin becoming legal tender. That happens this week in El Salvador, and we're going to be diving into what we can expect from that historic moment. Second, we're going to be looking at wages in the US and asking the very important question, are wages keeping up with inflation? The answer might surprise you. And last, but certainly not least, it was Ethereum's highest weekly close ever. We're going to look at that price action as well as what's going on in DeFi. So it's going to be a packed one today. Grab your coffees. Starting as we usually do with Bitcoin, we see that last week Bitcoin closed a very impressive week with a last minute rally on Sunday evening, and that helped it finish the week up 6.15%, very poetically, at $51,809. As we can see, the close was actually squarely above these two resistance lines that we had essentially highlighted here in last week's episode. So very strong from a technical standpoint as well, the weekly close. Now, while Bitcoin is up, and let's just take a quick look here, while Bitcoin is up quite a bit over the last 6 weeks, we see here that Bitcoin is essentially up north of 60% over the last 6 weeks. If we compare that to the price action of both DeFi and Ethereum, so let's just compare, highlight the Ethereum price action quickly in the same time frame. We see that Ethereum is up essentially north of 110% in the same time frame. And looking at the DeFi index from FTX, we see similar price action. So again, both DeFi and Ethereum are up 110% in the same time period that Bitcoin is up 63%. We're going to be diving into this more in our DeFi section today. Now, going back to Bitcoin, the eyes of the finance world and the Bitcoin industry this week will be focused in El Salvador, as the Bitcoin law comes into effect, making Bitcoin officially legal tender in the first country in the world. So again, very, very big development happening this week. And naturally, we're seeing a lot of headlines around this event. Now, many industry participants, such as Alec Gladstein, Peter McCormack, and others, are in El Salvador to document this historic event this week, which is very exciting. Now, while there has been a big focus on how small merchants are using Bitcoin to accept payments from foreigners, there's yet another very interesting shift happening. And that is that large companies like Coca-Cola, Pepsi, and McDonald's now have to officially accept Bitcoin in El Salvador. This may prompt some of them to discuss whether to leave some Bitcoin on their balance sheet. Again, these are fascinating times ahead, so we'll be looking at these developments very, very closely. Now, despite the clear optimism in some camps, there's a segment of the population of El Salvador that still believes that there will be challenges around the implementation, as highlighted by the headline that you see behind your screen right now. How this plays out, of course, remains to be seen. We, as many others, believe that the law has the potential to change people's lives for the better. We wish the best of luck to the people of El Salvador in this historic week. Now, price-wise, the media attention around the event will likely be driving price pressure to the upside, and based on the macro backdrop, again, the bias this week could be to the upside price-wise. Checking back into the institutional world of Bitcoin, another big firm last week announced that it was getting exposure to Bitcoin, and that was none other than US Global. US Global is a renowned gold investment firm with over $4.6 billion of assets under management. The firm invested just over $500,000, or around 20 basis points of the fund's total assets, in GBTC, similar to what we saw yesterday or not last week with the likes of JP Morgan and Morgan Stanley. Now, we covered El Salvador, we covered institutions. Now let's look a little bit at what we're seeing on chain. And for that, we wanted to share this graph that was courtesy of Willy Woo, a very well-respected on-chain analyst, very big fans of Willy's work. He shared an insightful indicator last week, which you have on your screen right now, modeling Bitcoin's price behavior by looking at the Bitcoin supply on exchanges versus the Bitcoin supply that is in long-term holding wallets. As you can see from the model on your screen right now, and I'm just going to try to find a better version of that graph. Just one second. So here's Willy's graph, and this one with the line looks a lot better. So as you can see from the graph that is showing the line there, essentially this modeling compares the price of Bitcoin to the modeling of the same price based on liquid versus illiquid coins. And as you can see from the line of best fit on the plot and the graph that you have on your screen right now, it shows that essentially price trends to follow this relationship between illiquid coin accumulation and liquid coin accumulation. So all this, in a nutshell, what you can see in the graph is that illiquid holders have continued to accumulate, which signals that the price could be heading higher in the near term. So very interesting insights from Willy's model right here. And we're going to be talking a little bit more about what we can expect this week price-wise in our What's Ahead section later today. Moving over to our analysis of the S&P 500, we see that equity markets continue to ride high, with both the S&P and the NASDAQ reaching fresh new all-time highs last week. As we can see, the S&P 500 last week closed at 4,535 points, up 53 base points. And the NASDAQ, as we mentioned, also had a blockbuster week, finishing up 2.26%. at 15,432 points. The Dow, even though it did not make a new all-time high last week, it was essentially its third highest weekly close ever. So again, equity markets in the US continue to be in great shape. The big surprise last week, as we highlighted here on last week's episode, came on Friday last week with the non-farm payrolls number out of the US. That was the reading for the month of July, and it was a disappointing increase of 235,000 jobs versus an expectation of an increase by 765,000 jobs. So a third essentially of the expectations was what the actuals came in at. That was interesting for more than one reason. To highlight some of the nuggets that came out of the report, we wanted to share some of the articles. So as you can see, this article that was picked up by the Wall Street Journal essentially highlights that hiring has, slowed down sharply for the month of August in the United States. Interesting nuggets, diving deep into some of the numbers, is that hiring in the services sector has essentially come to a halt. They added no new jobs in the month of August, and we'll come back to this service sector update shortly. Now, looking at manufacturing jobs, those came in better than expected, many of them going to the automotive industry, which makes sense given the slew of shortages that we have seen in that sector. Now, to touch a little bit on wage price or wage inflation relative to consumer price inflation, that there's a headline that you have behind your screen right now is from Walmart. And essentially, Walmart is saying that it's hiking its wages by $1 to its entire, essentially to large part of its labor force. The increase is interesting because at $1, it brings the average salary from Walmart, or the average hourly earnings, to $16.40, which means that a dollar increase in this average wage is essentially a roughly 6% annualized increase on the wages. So if we look at the numbers from the data, separating Walmart aside, the average hourly earnings increased by 0.6% month over month, which equates to an increase of 7.2% annualized. That's on wages. So wages are rising by 7.2% annualized. That's higher than the inflation rate. The inflation rate, as we've been seeing, is basically coming in within 4 to 5%, depending on whether you're looking at the core PCE or the CPI, which again, both pretty historically speaking ways in which people track inflation. So we're seeing that wage inflation, in short, is outpacing the inflation that we're seeing at the consumer price level. So that is actually a very good thing for the American economy. Now this week, we do get a look at job openings in the US. The expectation is for 10.1 million job openings. Remember that we only have about 8.6 million people in the United States looking for work or considered to be out of work. So there's a big gap between the number of employments or number of jobs that need to get filled and people even looking for work. Now, this brings us back to the point we made around jobs in the service industry. So as we've seen, there's upward price pressure on wages. And there's a thesis that jobs aren't growing because employers and prospective employees are at a standstill. And basically, prospective employees don't feel like they're getting paid enough to go to some of these roles. Now, the end result is that employers will likely have to pay higher wages, and this should drive restaurant food price inflation higher in the coming months. So again, we're going to be looking into more what we can expect on the macro side in our What's Ahead section later today. Moving over to gold, we see that gold had a pretty good week last week, up 53 base points and closing in at $1,826 per ounce. Not surprisingly, essentially all of the gains for gold came on the back of Friday's move, which essentially brought gold up 94 base points higher, or basically almost 1% higher, and helped it close the week in the green. Now, obviously the move on Friday came, as with many other markets, because of the reading in the non-farm payrolls number that we highlighted in last week's BEC. Now, there's a few factors playing out in gold's favor. For one, the macro backdrop, it's looking like it's looking positive. It's looking like inflation is going to be allowed to run higher. From a technical standpoint, again, we see that these resistance lines that we had dating all the way back from the August 2020 trend line have now become essentially support. And that is a pretty good indication from a technical standpoint. Lastly, historically speaking, September tends to be the best performing month for gold due to seasonality. And for that, we wanted to highlight the chart that you have behind your screen, which essentially tracks the average returns for gold on a monthly basis since 1973. So as you can see, gold tends to be, September tends to be a pretty good month for gold, historically speaking. Now, while this should not be considered or seen as a signal that gold always goes up in September, if we understand what may be driving this behavior, we could see how this trend or essentially behavior could play out this year. Now, historically speaking, September has not been a great month for stocks. This could have to do with the fact that many investors return home from the summer to act on their portfolios. If the year has been good, investors may look to take profits and roll it into gold or bonds. If the year has been bad, investors may look to start thinking coming September around tax harvesting some of their losses and setting up the positions again in the new year. Either way, they look at their portfolios and act when they come home from the summer. Now, both Bitcoin and equity markets have had an incredible run this year. Keep that in mind as the month progresses. Both may face some profit-taking headwinds from investors returning home to their portfolios. Checking in on our DeFi segment and Ethereum, we see that it was an absolute monster week for the DeFi index, finishing up 20.41% for the week. Now, Ethereum also had an impressive week. It finished higher, 22.5% at $3,951. As we've mentioned here, Ethereum continues to gain momentum from a narrative perspective. With popular names recently getting behind it, the one last week that we wanted to highlight was Reese Witherspoon, the Hollywood celebrity. Obviously, mainstream endorsements like Witherspoon's increase the exposure of digital assets to a much broader audience. Now, another narrative that's picking up steam is the Solana versus Ethereum narrative. Staying in line with the celebrity endorsements, we saw Jason Derulo last week also essentially share his support for Solana last week. Could these be top signals? We don't know. It is important to keep in mind that the US consumer has a great balance sheet and a lot of pent-up firepower. So, keep those two things in mind as we continue to see most likely some of these endorsements. Now, let's spend a minute comparing Ethereum and Solana purely from an asset price and market capitalization perspective. We will leave the tech discussion for a later time. But let's take a quick look at the price difference between both of these. First, to do so, we're going to compare Solana essentially and put it side by side with the Ethereum chart. Now, if we look at basically 1 year out from where we are today, we see that Ethereum has essentially returned around 1,000% over the course of the year. This means that an investment in Ethereum a year ago would have returned essentially 10 times what was invested over the course of the year. As you can see, the orange line here, this is the Solana returns over the same time frame. Now, over the exact same time frame, Solana has returned a whopping 4,655%, or basically 4,650%, which means that an investment in Solana would have returned essentially 45 times the original investment over the same time frame. So again, very interesting to see the performance difference between these two assets. Now, in terms of market capitalization, Ethereum is currently sitting at around $456 billion of market cap. Solana's market cap is closer to 40 billion, meaning that Solana is approximately 1/10 of Ethereum. Based on the speed at which Solana is gaining mindshare around developers and investors, it would not be surprising to see this trend continue. Another big development from last week in the DeFi world was the news that the SEC, the Securities and Exchange Commission, is currently probing decentralized exchange Uniswap. Uniswap is the largest decentralized exchange in the world and an industry darling. It also has the backing of some world-class investors with deep connections. Now, despite that, the SEC has made it clear that it considers many activities in DeFi to be deemed securities. Any action towards Uniswap would likely be a landmark motion with many ramifications across DeFi. We will continue to monitor this very closely. Moving over to our Bitcoin mining difficulty commentary, we see that not much has changed on this front. The next difficulty adjustment should kick in around Wednesday morning and should bring difficulty higher by around 3% to 18 terahash. The mempool, as you can see on your screen, remains eerily quiet, with next block confirmation fees in the single Satoshi mark most of the time. Elsewhere, the narrative around Bitcoin miners moving from China to the US continues to strengthen, as seen by the article on your screen last week from the BBC. Now, headlines like these, or the one that was shared by BBC, why China's Bitcoin miners are moving to Texas, are highlighting the opportunities to a mainstream audience. And again, the opportunities that are basically miners are seeking to move from unfriendly jurisdictions to friendly and clean energy jurisdictions. Little by little, the image of Bitcoin miners is getting a makeover in mainstream media, and this is a great thing for Bitcoin. Now, as always, we leave you with what's ahead for the week. Now, it seems like the stars continue to align for equity markets and Bitcoin. The Fed tapering continues to be punted away due to bad economic data. Inflation is increasing moderately, with salaries seemingly keeping up. Unemployment is on the way down, with more job openings than people looking for work. Companies are churning profits. A fair question could be, what could possibly go wrong? During good times, it is wise to understand what could trigger a change in direction in the markets. While things can feel great now, everything could turn on a dime. So, what could go wrong? Many things could derail the current market conditions. However, investors should be particularly aware of two main risks. Number one risk is good news, which may sound counterintuitively. But if economic data, particularly around unemployment in the US, continues to improve, this could lead to the Fed accelerating its tapering plans and therefore spooking markets. The other growing concern around markets is the giant Chinese conglomerate China Evergrande. And for that, we're going to switch back so you can see the headline on your screen. Now, China Evergrande is the most indebted property developer in the world, with the reports from the Financial Times claiming it is $89 billion in debt, and some other articles suggesting that the total debt could surpass $300 billion. The company, with projects in more than 200 countries, is under pressure from Beijing and regulators to reduce its debt load. It is currently looking to sell assets, including its stake in an electric vehicle company that has not yet shipped any actual vehicles or commercial products. If Evergrande goes under, it could cause contagion around other Chinese lenders, and that is reflected in some of the headlines that you're starting to see, which show the bond prices of Evergrande trading at 28 cents on the dollar and how that's dragging down the bond prices of other Chinese developers. Now, the China Evergrande situation is being monitored closely by bond market observers, and we will continue to provide updates in the weeks to come. Now, as always, we wrap up with a summary of the upcoming economic data and earnings reports that you can expect for the week ahead. Starting with Monday, today, it's actually a Labor Day holiday in the United States and Canada, so it's a quiet day as far as markets and economic data. Wednesday this week at 10 a.m., we get job openings in the United States. And after market close, we get the earnings report from meme stock GameStop. So that will be interesting as well. Thursday this week at 8:30 a.m. Eastern, we get initial and continuing jobless claims out of the United States. And at 10:30 a.m. Eastern, the SEC Investor Advisory Committee has a panel discussion on reimagining investor protections in a digital world. So very likely that digital assets will be discussed in this panel discussion, so could potentially impact Bitcoin and crypto markets. Lastly, on Friday, we got 8:30 a.m. Eastern, we got Producer Price Index with expectations for a 1% increase. And at 10 a.m., we got wholesale inventories. Expectation is for a 0.6% buildup in inventories. As you know, we follow the buildup in inventories very closely, as those could lead to potential deflationary pressures in the future. So, interesting week. We've covered a lot, and there's a lot happening, namely the El Salvador legal tender event. So if you enjoyed this show, if you have any questions, comments, feedback, we welcome you to drop it down in the comments section, and we'll look to include it in the next episode. If you like this show, if you enjoyed it, or if you learned something today, I welcome you to like it, subscribe it, share with your friends. If you don't yet have a Ledn account, I welcome you to check out Ledn.io and learn how you can start earning up to 9% APY on your USDC and up to 6.1% on your first 2 Bitcoin. We also have market leading rates in loans, dollar loans backed by Bitcoin if you need cash but don't want to sell your stack. Thank you, everybody. Have a wonderful day and see you next week.